Welcome to the 2023 second quarter Open the Kimono report. So the way I record these, the first half, which is this going to be about the first hour, is going to be more high level update on what's been happening, macroeconomics, what's been happening in the real estate industry. And then in the second part too, we'll be going through the deals individually and teasing out lessons learned, some deals that are going positive. Why? Basically to help out you guys from a high level. What should you have looked at in deals previously, or any little tips I was able to pick out from the projects going through this last quarter. But first, let's start off with a little bit of state of the union here. Unemployment. So I've been making this chart for the last, I would say, 3-4 quarters, where I keep things all in relation to each other. The reason why I do this is because I started to get to a point, especially these last couple quarters, where everything seemed very stagnant to myself, because I'm in it every single day reading headlines, and it seemed like I need to take a step back and look at things from a quarter to quarter basis. So that's what this attempt is to do here, to see how things change over from quarter to quarter. So you can see how the unemployment, GDP kind of has been moving. I would say the big mover here is GDP has been coming down slightly, which is, I think, great, right? That's exactly what the Fed wants to do. They don't want it to go really negative, even though that's what a recession is, 2 quarters of negative growth. But you're seeing this come down. The unemployment is staying really good at 3.5%. Although what I've learned recently is unemployment's not really going to start to be a leading indicator. It's going to be a very lagging indicator, like 2 years down the road, of when the Fed hits those interest rates, or when those interest rates are impacted in the economy. Because think about it, Fed increases interest rates, then maybe a couple quarters go by, a few quarters go by, then employers, maybe I should stop hiring, right? And then they stop hiring, or they think about not hiring. And this is actually what we talk about in my business mastermind, Vistage, I'm a part of. People right now are thinking, our volumes are down slightly, 10 to 20%. Should we cut back on our force? I hate to do that. Maybe I'll do that next quarter, right? So if that's just one anecdote there, you're seeing the unemployment's really not going to be coming down until maybe another quarter or 2, or maybe even 3 from now. So I think for people to feel like the unemployment needs to come down drastically now, I think is a little bit far-fetched. As far as CPI, now that is impacted and felt a lot quicker. We've come off the highs here relatively quickly. So 2022 quarter 3, we're at 8.2, now at 3.2. Of course, the Fed is measuring at the core inflation rate, which is a little bit higher, but they want that to be about 2%. Don't know if that's just wishful thinking on their part, or just a lofty goal that they're putting out there to keep doing their hawkish rate program. But if you guys are interested in this, what I would suggest is check out our weekly updates, where I follow this almost every day, what the interest rates are doing. But as far as this report goes, just wanted to give a little bit of a high-level overview. The Fed is now at 5.33, and this is up from 4.83 from last quarter. However, we'll go into this more in detail. I have a slide on this and what the forecast is. And these next 2 items here, uncertainty and where I think stocks and equities are, if I'm bullish or bearish or not, I would call it a 6 in terms of my uncertainty, which means like I'm a lot less uncertain than I would say I was really uncertain quarter 4, 2022, almost half a year ago, where my feeling is like we're seeing the light at the end of the tunnel. I'm seeing volumes pick up on the multifamily transaction side, and we're seeing that light at the end of the tunnel in terms of rate increases. As far as stocks, I don't have any stocks. We've seen it run up here a little bit, but it just seems, man, we're just due for a correction here based on everything's been going down. Real estate went down 10, 20% this past 6 months. Seems like it's hitting that bottom now. Stocks and equities really haven't seen that correction yet, and it makes no sense to me. As far as an investment group goes, the acquisitions this past quarter, we purchased the Conroe land. That was a tough one. We had a scare there at the end. A lot of the lenders are real shaky these days. And we had a lender scare there where the lender just wasn't able to lend for some reason. And usually it comes from somebody's decision high above and their bank saying like, yeah, we just can't do it. Not anything because of like the deal or anything like that. But we were able to scramble and close the land. So that was a good thing. We faced problems, we get over it. As far as we'll go into upcoming projects, but some sales that are coming up. The Hilton in Times Square is getting completed. The JFK Holiday Inn now does look like we're going to be putting that back on the market. I'll go into that more in detail in part 2. Brookridge is selling, Harlow's selling, Silverstone is selling. Some good deals that were reaching the end of their business plan are selling. We didn't really buy anything this last quarter other than just raw land. And here are some of the strengths and weaknesses in the economy over the last quarter. And you can see if you want to benchmark it against the last few quarters, what some of my commentary was. I'll read some of the highlights here. Some of the strengths is unemployment's really strong, 3.5% is really low. I think the Fed has always said they wanted to see about 5%. And why is the Fed doing this horrible thing? And I had discussions with this past week within my business group where, man, isn't like corporate salaries just still so high? And there's all these like Gen Zers. I say Gen Zers because technically I'm a millennial because I was born in 85, but it just seems like a lot of the newer talent, working talent out there is not really hard workers and getting paid 100,000 plus after college. I never got paid that out of college. But part of that is unemployment's really low. And the discussion that we had was when unemployment is in the 3s or even the 4s, you still have a lot of people doing nothing, having jobs. And not until you get over that 4.5%, 5% unemployment mark that you are able to cleanse those people out. And therefore, the peak wages really start to normalize there. Let's face it, guys, for the past decade, wages have been pretty good. And that's what's been one of the reasons why inflation has been so high. So from the business owner standpoint, you get a lot more work output value from your employees when there is a little bit of a fallout like this and correct it back up to normal unemployment and normal employee-employer's power dynamic. And then the good thing for us, household formation is expected to increase as the Gen Z moves out of their parents' homes and enters the workforce. I think they're not going to go buy houses because they don't really want old stuff. They rather have newer stuff, and all they can afford are apartments. Some weaknesses I see right now, you're seeing a lot of these building starts, whether that's apartments or single family homes that got started in 2019 and mid 2021. That was, if you recall, when the interest rates started to peak up. And now those things are coming to market now 2 years later. There's a 2-year roll. When you start construction in summer of 21, your product comes to market and floods the market with new inventory in 2023 summertime, which is now, right? We'll talk through these issues of having to compete with a lot of Class A inventory coming out there. And on some of the projects, this is why it's struggling to get over that 80% hump in terms of occupancy. But I see this kind of going away maybe next quarter, probably more next year. Because think about it, a lot of the builders got the wind taken out of their sails in Q3 of 21, meaning that 24, 25 is going to be a down period where if you can get into construction now, hint everybody, you can get in there where there's not a lot of competition coming into the market. Other economic challenges, the M2 money supply is declining. That kind of talks about how much liquidity there is. And there was a lot of liquidity in the economy because part of it was during the pandemic, people just didn't spend. High interest rates, tightening credit, fewer dollars for spending, worsening financial metrics. Things are getting to a point where I think the Fed is just waiting for things to break and crack, like how we've had the SVB crisis. I think that was past quarter, and they're just waiting for what thing is going to break next, and then maybe that might be the stimulus, or they may act reactionary to, yeah, that's the end of interest rates. We got it. We're good. Well, now we start to hold it there. As far as opportunities go, I think this is the same narrative that we've been seeing for some time now, which is the affordable rental units. There's high demand for that. There's a shortfall of 308 million units in 2019, and construction mainly focused on luxury units. Home ownership rates are at a 53-year low. I think that is kind of here to stay, unless George Bush comes back again and creates some kind of program where everybody can own a house. Then that basically what was caused 2008. If you recall history, factors such as millennials accumulating less wealth, being more mobile, renting for longer periods, increasing demand for multifamily housing. And if you ask most millennials, myself included, we would prefer to have newer things. We'd rather not keep stuff or have this bigger McMansion. That's the general trend moving forward. And the single family housing market remains strong despite concerns of recession and rising interest rates, with home values consistently increasing, low inventory, and a higher mortgage payment to income ratio, leading back to the rent, making people move back to the rental market. Core economy declined likely in 2024. Recovery in 2025 is what I believe is the metrics, and it echoes that of ITR Economics, a group that has more institutional data group where they actually will advise other home builders, other businesses, and economists. Certainly not the run-of-the-mill YouTube influencer guys who just are in the gloom and put out fear tactics out there, but real data-driven metrics. And the housing starts high right now, and we know it slowed down a year and a half ago. And I think that is a big opportunity for us, especially in development. This next section here, threats and black swans. So if you notice, I took you through a little SWOT analysis, strength, weaknesses, opportunities, and here are the threats. But I also like to tease out between what's a real threat and what's a black swan, where this could happen, but yeah, Kim Jong-un didn't really blow up America like how we once thought a year ago. That was like a black swan. However, black swans do exist, where the Fed raises rates the fastest in history from 2022 to now. That it can always happen. And I would probably say in a 5-10 year period, you might see a black swan 10 to 20% of the time. And that's where I think investors need to understand that in investing, there is always risk, and you need to be in there and diversify over different projects, but also different time horizons. And I will go into the projects into part 2 here. But if you, one big hierarchy theme or lesson learned is like, there's an investor I chatted with the other day, and he was in all these projects that originated in 2020 to 2021. Some people have no idea of kind of the struggles within the economy right now. Sometimes it's good to be ignorant, and it's good to be lucky. But in reality, what was the lesson learned was this guy happened to invest in the right time. I always say try to bridge yourself through multiple years. But if you met me in 2020, you started at not the greatest of times. That's okay. It'll come back. But it also means if we met recently, now is actually one of the best times to come in and enter, because prices came down 10 to 20%. And I think it is up from here. What I think is a threat in the economy, when will the assets prices bottom out and buyers, seller reach equilibrium? And I think this is the big question, and it's becoming a little bit more clear. However, to assume that the interest rates are going to come all the way back to where it was that's not going to be happening for any time soon. And here's the interest rate slide I have, but this is the forward curve. The Fed, you can think of this as the Vegas odds in a way. So this is from Chatham Financial. I would urge everybody to book this website here. But these guys are the ones who sell interest rate caps. They have skin in the game. They know this stuff. So right now, what they're saying is in 2025, 26, to start to restabilize at that 3.5 interest rate range. It will not go back to zero. That's not going to happen. But you don't need the interest rates to go all the way back to that point. What you need is the interest rates to stabilize, number one, which they're estimating in January 2024, the end of this year, and for it to start to come back down. I would probably argue saying it's maybe half a point. At that point, that would be when the buyers come back into the market, where there's stability to come back in. And the buyers are really waiting to come back in. And then the other question or threat is the forecast assume dovish federal policy after they reach that high for them to release the rates pretty quickly as they've done in the past. However, that hasn't happened yet, right? So it's still a bit of a question mark. And I feel like the Fed, maybe it's probably too early to proclaim a victory, but I feel like the Fed has been doing this in a very calculated method where, shoot, these guys might actually achieve a soft landing or maybe avoid a recession altogether, right? Where we only have maybe 1 quarter of negative GDP growth in 2024. As far as the company focus, operational focus is preferred equity, not common equity, and then just picking up good plots of land to start off developments. Because right now, I can't really make multifamily value-added deals work where the interest rates are at. Maybe next year. And I think that's the first time I've indicated us returning to these types of deals. Of course, if you find that diamond in the rough deal, it precludes us. But generally speaking, I can't make the loan to values on the loans work. I need the capital markets to improve a little bit to get the financing to get the deal to work for the numbers that you guys are looking for. As far as company initiatives, we've filled up our investor relations staff. So for those of you guys who have been reaching out, if you notice, like we had some vacations there and we only had a person there at one time. Now we have 2 full-time staff. It is costly to run a business. That said, we've grown to a large amount of investors, 800. It's a lot of requests that we get every day. I would ask investors, if you're somebody who is always looking for a little bit of reassurance, have some patience with us, submit through email. Please don't text us. I know some people have been texting us. Texts get lost, right? It's hard. It's better for the team to move the request around via email. That said, if you need to talk to a human, pick up the phone and call us, right? The team manages the team line, and sometimes I get in there and help out too. As far as upcoming stuff, we are going to be rebranding to the Wealth Elevator. So the green simple passive cash flow logos will be going away, and nothing's going to change, folks. Don't worry. Actually, the good things are going to be changing, right? It's going to be a lot cooler blue Wealth Elevator. And because that's the next book coming out, and it's going to be pretty meaty book. I think it might be like 180, 200 something pages. So the editor's doing the final revisions on that. I expect that to come out in the next quarter, and then we will rebrand. And part of the idea behind getting rid of simple passive cash flow is a lot of our investors these days, you guys, cash flow is really not super important. And cash flow is great when you're trying to just get proof of concept. But let's face it, if you're getting 4 to 8% cash flow on a deal, that's not changing your life one bit, right? It's what equity growth, and that's why we've been drifting off to more and more developments here. But also, the Wealth Elevator seems to be the more appropriate rebrand, as the whole premise behind the Wealth Elevators, there's different stages in wealth building. Floor 1, where you're picking up rental properties under $500,000 net worth and then become an accredited investor. I think that's most people here. And then when you get to the higher rungs of 4 to 5 million plus in net worth, the Wealth Elevator book breaks down those in terms of different strategies. It's not a book that just says, oh yeah, you can find syndications, and then that's the golden ticket. It goes in much, much more detail on that. I would say probably half the book is written about that one topic that most books talk about it in one sentence or a paragraph. So that's coming up. The website will change. The members website will change too, where all the deal updates are, and the e-courses will change also. So that's going to be a huge improvement. The signing portals will all remain the same. And the signing portals, I would say, are always the primary places that you guys need to go to check out the news on the deal. Whereas the members page or portal is going to be that secondary place where we duplicate all the reports there for a little bit easier reader digest version. As far as community events, we don't really have any planned for the rest of the year. I'm thinking of maybe doing a site tour in Texas because we're kind of due for one since we did Huntsville last year. Nothing planned as of yet. I would say the next opportunity, if you guys want to put on your calendars now, is in January 2024, that Martin Luther King weekend, the 3-day weekend. That's when we usually do our Hawaii retreat. However, I live here, so I'm a little bored of Hawaii personally myself, even though I shouldn't think that way. It's more for you guys. But yeah, let me know if you guys would prefer Las Vegas or Hawaii. We just switch it up one time. And then I've been doing office hours and syndication education webinars for you guys every third Saturday, and those office hours are every first Saturday. So if you guys ever have any personal finance questions, ask for a friend type of questions, you know, check out the office hours. And then if you really want to get more into the nitty gritty or academia of syndication deals, check out that third Saturday, and then you can ask live questions there too. I usually have an hour of a prepared webinar format for us to go through to start. So let me roll into a little bit of a presentation, about a dozen slides here. So K1s first. For those of you guys, I think we got most of them out. We're still waiting on at least a handful. We had the conversations with the handful of CPAs in terms of, hey, the last couple of years have been pretty poor. Of course, we've communicated the changes in the industry, right? It's hard for CPAs to get professional workers to work for them. I would also add on to that, like this past quarter, something I learned, a little bit of an industry secret, is a lot of the people that you guys will use as a service provider, maybe you've heard them on a podcast, you like what they say, and you signed up for them to be your CPA. Newsflash, a lot of them are just using overseas staff to do it at the very least, if you're lucky enough for them to be doing it in-house. Most of them are just sending it to a smaller third party and white labeling their services. In other words, a lot of these guys, especially if they're good internet marketers with YouTube's podcasts, etc., they're not doing the work that they're doing. So that's why we've switched a little bit, and we've been working with a little bit different vendors. So if you guys need a CPA referral, who's going to be a little bit more transparent with that and also charge you a better price, let us know. Shoot us an email, team@simplepassivecashflow.com. I think their hourly rates are like $250 an hour, which is pretty great. But from our perspective, on the business return side, we also test different CPAs out, and a few of them, some of those tests perform better. But we hear you guys obviously are wanting the K1s quicker, so we're opting for probably smaller boutiques next go around. And I'll just share from my personal side, like I have like over 90 K1s, but last time I checked a month ago, I was probably missing a couple dozen. And so I sent a question over to my CPA, and they said, yeah, just file the return and then just do an amendment later down the road. And this is actually what I've been doing for the past 2 years, because I just have so much K1s and deals, and the CPAs, they tell me, yeah, it's no problem. They actually prefer me doing this so that they don't have to be jammed up in August, September every single year. And yeah, 2021 tax return, I actually just mailed that all off and filed it 2 or 3 months ago. Seems a little bit after the fact. When a lot of these K1s that are coming in, think about it, are a lot of it's negative losses. It positively impacts your tax profile, if anything. So to do an amendment, most times you're not going to really be facing like penalties or interest charges or anything like that. Although I was looking at the interest rate charges, I was charged for some other things. It's nothing. I actually prefer to pay interest to the government at their lower rate than what rates are at now. So other news in terms of multifamily here, deal volume has been falling very greatly at a pace of 60%. So this is the reason because of this is fear, especially I would say half a year ago. Pricing, interest, the biggest ones are interest rates. If you do a root cause analysis, interest rates high. Now, if you're a buyer right now, and we are buyers too, so I'll tell you exactly what we're looking at. So if we're a buyer, sure, the interest rate that we would normally pay might be a little bit higher. Instead of paying like 4%, 4.5%, now it's 5.5. But the biggest thing is the loan to values that I would get. Like previously, I could go get 70% loan to value on a project, and maybe I would have to bring $10 million to the table to close out the deal. Now with loan to values in the 55% range, just in general, a lot less than 70%, I have to bring $14-15 million to the table. And what that means is now I basically brought almost 40-50% extra equity to table, which lowers the returns by that much. And I can't, unless anybody wants to invest in a deal where you get 40% return on your money in 5 years, I don't think that's very palatable to investors. Of course, I think investor mentality and investor expectations need to calibrate in the future, but let's face it, that's why we're not really doing stuff right now. And that's exactly why the deal volume dropped off about half. But it's starting to rebound a little bit. Rent growth was cooling a little bit, but demand for apartments are starting to rebound in 2023. This is a graph of net absorption. So this takes into account, like, all right, you're having a new amount of inventory coming on the market. And like I said, there was a bit of a run up in 2019 to 2022 and a half, where there was a lot of extra inventory being purchased at that time. So that you're not seeing that on this chart. This is just the net absorption, right? There was a big amount of demand that was coming through at the tail end of this chart, yet it's still being absorbed in because of the undersupply. But that faucet should shut off here in the next quarter or two. And then you're going to have the rent growth increase from there. So in 2022, you saw weak demand for housing, including apartments. And like I said, you're starting to see it reverse here in 2023. And I think it'll get back to normal in 2024 when you have that outside impact of all that extra new inventory coming online. That said, rents are increasing slowly, occupants stabilizing a little bit higher. And then demand will be strong in the long term, but mismatch expected through 2024. So here are the cap rates. And so this is at the end of the funnel. Fed increases interest rates, dampers the buyer's sentiment. The buyers stop transacting, as we saw here. And this is what's happening in terms of what's being absorbed, in terms of occupancy. And then that all impacts the cap rates at the end, right? What are the assets trading for? Because this is impacted by supply and demand. So supply and demand is buyers and sellers. The buyers went away. Therefore, the prices came down or the caps lowered. So falling prices increase uncertainty in predicting returns. And that's why a lot of questions of what are projections at right now? It's not fair to use the cap rates of where they're at today, right? It's not a normal cycle we're in right now. We have to wait till it comes back to normal. But until it does, I'm not going to say where projections are at today. Say your kid is 12 years old and they just had a good year this past year. They got some B's instead of C's. And now it's saying, what college do you think they'll end up in? It's just too early to tell at this point. The bread needs to stay in the oven for quite some more time here. And I would probably say for this to happen, probably at least a couple more years, at least. But I think this quarter from a high level, I'm starting to really start to see that bottom being hit, or at least being established, and we're seeing that reversal. This is what's happening in terms of the rents, which is a great indicator of net absorption. But what are people paying, right? So we saw a slight dip in October to February, I would say Q4 of last year, or Q1 of this year. And you're starting to see us get back to that more stable growth, which I would say mimics normal inflation, right? And this is why we try to underwrite with that 2% increase in rents, 3% inflation, that range. So that's the top graph here. On the bottom is your occupancy. You're starting to see that track down a little bit. They are correlated a bit. They don't always 100% correlate, but in most cases they do. But right now you're seeing the occupancy tick down a couple of percentage points from the high to the low. This is to be expected. This is definitely, I think, what we're seeing across all our assets for the most part. There is, if you really want to get really technical in it, there are ways to keep your rent, your statistics high on the rent side by offering concessions and whatnot. There's also ways to mess around with your occupancy to keep it high, which is why there's always a bit of a lag in the data coming out. But I would probably personally verify, yeah, in February 2023, there was a kind of a soft spot that we felt in terms of rents. And we're starting to feel like the normalcy is coming back out, which I think mimics a lot of kind of what these other graphs are showing here in terms of that bottoming out effect. Percentage of net additions to all property supply in major global cities. So this is the big one that I'm keying on in terms of future development. So if you're following what this is saying, so this is the percentage of new inventory coming in there as a percentage of what's already out there. So I think that's a creative and I think a good way of normalizing the data in there, because not always these charts show things that are actually true. But I think the way they did this with percent net absorption and net addition to supply, I think is smart. So we saw that run up in 2019 to 2022. And then once the capital markets got soft, which is the lenders, because the interest rates started to increase, every builder got the wind taken out of their sails in 2021, Q3, Q4. So that is about here in the chart. So what happens is they push through because they were committed already. But at this point, there was a crossover point where Q2 of 2023, a lot of these builders are just like, let's just stay on the sidelines. And this is exactly why I'm saying, you gotta just push through this point, because the competition going to market 2 years from now, when these guys come out of the pipeline, there's gonna be less competition to compete with us coming out of the end, because there was a 2-year pipeline. This on the upper right, this is from a different report, but it's showing that's the same phenomenon where you're going in. And this is, I believe this is the more of the building costs. So building costs tend to go up when a lot of people are building, when there's other people buying, a lot of buyers in the market. That's what pushes the price up. And then on the bottom here, similar units coming online. This is, I would say, pretty much the same chart, but a different way of showing the data here that's showing the same thing with this general bottoming out in new people coming in 2023, meaning that if you can get to build at this point where we are now, it's an opportune time. It's another analogy I'll use for this is in the beginning of the pandemic, not a lot of people were having babies because people were a little freaked out with the whole COVID pandemic, right? The first half of the year. So that means fast forward 20 years from now, there's not a lot of people going to be going out to the job market when they're 21 or 18, right? So that would have been a nice time to be born. Of course, in the second half of 2020, there's a pent-up demand, and now a lot of people were at home shagging up and having kids. So there's a kind of a boom, a baby boom in a way, mini COVID boom. I don't know what people will call that in the future, but it's the same impact, right? For construction, there's usually a 2-year lag when you start and then when it comes to market. So here are some of the portfolio level findings from a high level, split apart some of our major markets. First on Phoenix, which is acts like more of a West Coast market. It's a little bit more, remember in 2020, 21, the rents skyrocketed 20% in 1 year. So it's a little bit more of a cyclical market. The challenge there is that we're seeing increase in expenses, labor costs, and material sourcing. Similarly to the Texas, Alabama portfolio, however, I would say the labor cost is a little bit stronger on the Phoenix side. The property taxes and insurance costs significantly increased, probably 2x. We're probably seeing a lot more of that on the Texas, Alabama side. Minus Alabama. Alabama's the least in terms of taxes. And the interest rates increasing impacts cash management. And if you guys want to write up on what we go through for draw requests, let us know. Shoot us an email. We can send you a full write-up on that process. Positive outlook on workforce housing. It's needed more out there. We're progressing with our newer property management firm that we got into the seat late last year. We're also filling in asset managers and some of their shortcomings. That is where the puzzle needs to be put together, right? Where the property manager and their regional staff come in and we support in different ways. And for us, it's a lot of it is pushing the marketing, pushing those leads through the process and getting it to completion of a leased up tenant. New inventory flooding the market, affecting occupancy. We talked that several times. And efforts to mitigate tenant turnover and evictions. I think we're not seeing as much overall anymore. However, in the rougher areas, that's where we're still seeing those evictions flush through some of these properties. We don't know when that's going to end, right? That's one of the unquantifiable things, the unknowns. But since we've been facing it for quite some time now, and the theory is a year to 2 years or 18 months on average, how long to flush through the majority of the tenants. I'm thinking maybe the next quarter or two is when we might see that sunset on us, thankfully. But every month that goes by, you get some of those tenants out, things get better and better. And then some of the elevated eviction amounts of people, like people moving out, we've been seeing some properties as high as like 50% of the tenants. So if you lose 12 tenants because they're just moving away, normal turnover, half of those may be from evictions, which is very high, which is not an indication of you had bad customer service or anything like that. It was just wrong person was put in there, or they just went through bad personal circumstances that they became not a good paying tenant after some point. But the fact that it's so high and elevated alludes to the conclusion that those tenants weren't the best tenants put in there in the first place. And that's something that when we take over, that's what we have to deal with. That we're unfortunately in the business of dealing with those problems. As far as the Texas, Alabama side, some of the differences there in Texas, especially Harris County, or if some investors are in some of the more urban areas like Dallas, man, taxes have skyrocketed, sometimes even 3x, and also insurance. So insurance is this top graph right here. You're seeing some of the worst states shown in red. Some of that has to do with the Gulf states. So Florida, of course, Louisiana, Texas, they're in a lot higher category in terms of risk being right on the coast. Where if you're not on the coast, this graph just depicts not by county or city, but more of a state perspective. So they rate it as red there. And we did a little exercise where we went back to the drawing board, and this taxes and insurance thing, man, this is a problem. Started to look, let's reconsider some of these green markets, but they're just softer markets. There's just not as much demand. We're seriously looking at one. We're going to buy a mobile home park and get rid of it and build new stuff on it in Indiana, actually in Bend, where Notre Dame plays. But yeah, it just didn't work because the numbers just weren't there for population growth, job growth, that type of stuff. Pulled back on that one. You're seeing some of the broken down by insurance costs here, some of the biggest increases there. And then just one anecdote from our portfolio, Terra Oaks in Texas, in Houston. When we closed that deal, we were at $85 of insurance per unit. So for those of you guys who own rental properties, you're probably thinking, yeah, that's what I pay on my single family home. But now just 2 years later, that has skyrocketed to $2,900 per unit. Right? So that's more than a 3x increase right there on just insurance. And then don't get me started on taxes, right? We're in the midst of appealing a lot of these taxes. but that has definitely skyrocketed. I would say more so in Texas, because Texas had a big run up 2015 to 2020. And it seems like it takes a longer time, maybe 2 or 3 years, for the taxes to readjust. Arizona's not as bad. But then also you layer on top of that, hey guys, we had a 10% inflation for a couple of years that increased all expenses on the P&L sheet too, right? So that's some kind of where we're working our way through, and everybody's in the industry is working a way through that. Some problems also on like utility costs are also rising. You could probably put that under the inflation cause. The question from Ben. So you mentioned the upper Midwest. Have you guys looked at Madison, Wisconsin in the green insurance area from your map? Politically red state and top 5 U-Haul for cities report last 3 years. Also, it may diversify a portfolio balancing more extreme temperatures in the summer of southern states, which may get old to some. So I'll refute that last sentence. It doesn't matter if it's the summertime is too hot. It's generally like we go off general trends, right? Where is population growth going? I would recommend reading the book. I think it's Big Shifts Ahead, where they talk about these real macro movers in terms of like where are people moving towards. It's all to the southern areas. What I would do is I would look at, maybe I'll do this right now for you guys, but like Madison, Wisconsin isn't a very strong market. I quickly look it up on Google, and it's under 250,000 population. That would put it in more of a tertiary market category. I'm just not really looking to invest in tertiary markets anymore these days. They work when the market is good, but in times of struggle, that's when people suck back into the secondary markets, places that are 500,000 in population. Now, if you guys are still doing a little bit of mom and pop investing on the side, or you live around there, I think that's great. A great way to diversify your portfolio geographically. Have a little stuff in Florida, have a little stuff in Arizona, Texas, and then Madison, Wisconsin, especially because you're boots on the ground up there. But yeah, that's something that I think I would really target. Like I said, we're looking at Indiana a little bit, but just the metrics aren't there. Like we'll look at the CoStar reports in terms of where is new supply coming online. That's why the builders aren't really building too much out there, is because they're the smart money. They're seeing where the population growth is coming. And that's just not one of those places. But yeah, we'll continue to take an open mind to it. But just insurance is just one of them, right? Insurance and taxes make up half, somewhere close to their 40% of the P&L of the expenses. So it's a big chunk. But it also is what it is, right? And you can't just let that tail wag the dog. It's just one part of the P&L sheet. And if you're in a stagnant kind of area, which I don't think Madison, Wisconsin isn't too bad. I'm looking at the population here, and it's not too bad. It is a little flatline, like how most of these sleepier northern locations are. But yeah, it might be a great place for you to invest. But if there's any other question. Yeah, I think like for some of you guys, more active investors that might do invest in these types of deals for diversification, for amongst many other reasons. But if you still like to value add, flip your own properties, I think that's a fine strategy where you take a little bit of doing it in home. But I think a big mistake is having all your properties in one area, right? Especially when under your own management. That's not diversification at all. And sure, diversification is a cop-out answer to a lot of de-risking yourself. But I think it is prudent in most cases, especially when your net worth goes over $3 to $4 million net worth there. Drilling down here is from Yardi, a little bit of what's been happening at high level in terms of the rent. Phoenix, there's a huge run up in terms of rent growth. It skyrocketed all the way up to 20 to 24%. But then it came all the way back down. And I would say it's a little bit normalized now, which is, I think, a good sign to see here. And same thing with Houston, not as an extreme increase, but as you can see, the recovery has been a little bit better, not as bipolar as Phoenix. Other kind of more random notes, limited multifamily transactions for sale. We talked about this. Transaction volume expected to pick up, but still slow below 2022 levels. I'm starting to hear whispers from brokers of the kind of things starting to move back up. Things always move slower than you think, especially when you're ear to the ground like myself. So you really start to see it reflect in data and start to move probably next quarter. There's an indication of a floor and an ability for people to get agency financing at higher loan to values is starting to become a possibility here in, I would say, in the next quarter. The market shows signs of shifting. And we anticipate more movement and more motivated sellers by 2024. And I think this is the narrative. I think a lot of investors who always say, hey, I'm just going to sit on the sidelines and do nothing. And I think that's great if you have $4 or $5 million net worth, but especially under $2 million net worth, guys, now is the time to get involved. You just saw prices can come down 10 to 20%. Invest in things that make sense more in the long term. And you have to find an entry point, and you have to diversify your entry point too. And I would, to burst that bubble of, yeah, sure, there might be motivated sellers coming up in the next year, but as an operating group, I don't think necessarily we want to pick up these foreclosed assets due to heavy tenant issues, because you got to think about it. Once a property goes into those distress environment, the tenants aren't really kept in check. Deferred maintenance starts to increase heavily. Things aren't fixed. Property management staff don't care after a certain point. And it becomes a huge undertaking that I don't know if that we really want to be going into those types of projects here in the future, where I would just prefer to start with a piece of dirt and build from there and not have to deal with tenant issues. Sure, there's a lot of newer operators under $500 million of assets who would love to get started in their real estate investing careers and would probably pick up those properties, but I don't know if I have the appetite for that volatility these days. And we would probably prefer a little bit more like preferred equity positions or a little bit more conservative type of projects in the future. Been there, done that. If you guys have been, like, something that comes to mind is Trust Palms, where we exited that one. It was a successful project all in all, but man, like, we had 20% of the tenants routinely not pay every single month. Those, I don't know if that's what I want to pin my business as an investment company after, with a very management intense type of business. But we're looking for great deals that meet our criteria, right? Broad approved, high growth markets, safe debt, probably looking to target fixed rate debt in the future, or if we do floating rate, we've had some lessons learned in terms of ways to back it up in terms of liquidity on the general partnership side. If we were to get into that 2020, 2021 environment, maybe do restricted backs. So maybe doing only a deal like that a quarter. Other office buildings are in still deep recession. And I know some other operators in office. It's a new world out there. You can't assume you're going to run your property at 85% occupancy in the world of office. That new normal may be in the 70%. Good for us that we invest in apartments in a residential market, still in an expansion phase with limited supply. And then the retail and hospitality are already experiencing hyper supply. And then, like I said before, opportunities exist to invest, but I would say already acquired deals where you know what the problems are, you've uncovered the skeletons in the closet, and that unknown downside is eliminated there. And getting involved in these types of opportunities as opportunistic investors, I think that's the way to play it, as opposed to going into a brand new deal where has been foreclosed, you're getting at a great price, but you don't know what the skeletons are in there. No one knows what the skeletons are until you start to get into bed with it for the next 6 months. The last things here, smaller regional banks are facing challenges due to shrinking deposits and credit tightening. We do have a couple issues that we have remediated and worked through, but I think it's a small enough blip to be educated and have it be a part of our part 2 lessons learned. And then I would say if you're a newer investor, fresh money has an opportunity to invest in distressed and discount deals. Now's, I think, the great entry point. Interest rates here, we talked about this earlier, but this is the Chatham Financial forward curve. I think the light is at the end of the tunnel. These guys run a very large business in the world of like rate caps. I think this is all kind of pointing to the end of the interest rate hikes. And this is what the people with skin in the game and the experts believe as the Vegas odds, what's happening with the interest rates over the next few years. It's not going to be a quick decline, but it's going to be coming down. The question is, when is that point where the interest rates come back down so that the buyers come back in? I don't think that it's like halfway between here, which would be January 2025. But I think somewhere in 2024, people are going to have, or at least the buyers, the commercial buyers, the sophisticated money, and they're already starting to do this. It's already starting to pick up in deal flow. They're going to be a point where they decide, yeah, these numbers make sense because we're going to head up from here, and the cap rates start to come back. And so here's the big picture. This is the big summary slide. I would say macroeconomics, interest rates, unemployment rates, inflation here on the left. And here's the impacts to the real estate sector. And then here's some of the action items that we're moving off to in the future, which is to review asset exposure and sell off marginal assets when we can. Right now is just not a good time to sell off those marginal assets because they're just evaluated very differently than assets that are stabilized. Build cash reserves to weather market fluctuations, lean into development shortage pipeline now. Talked about that several times. This is more for new acquisitions. Utilize inflation as a strategy in 2023 and 2024, which means buy real estate. And I think everybody should be doing that too. There will be inflation. Even though the numbers are going to come down to eventually 3%, make no mistake, if you have your money sitting on the sideline, you're just going to be losing to inflation. So our strategy too is to buy into this and have inflation also increase the value of our properties. It worked in the past, it will work in the future. It's just, we went through a little bit of a lull here this past year, and which is why now is the time to get into it. And if you're thinking that stocks are high right now, I think that's a great bet to take money away from the peak stuff and into the stuff that's been beaten up, which is real estate right now. But yeah, like vast majority are still in the green there. But I think, like I said before, in terms of picking up new deals, I think we're a little hesitant on going after these more distressed properties because of the tenant issues involved with that. And it's hard to quantify getting into these deals where you don't know the quality of the tenant issues. Whereas if you're getting into a project where, you know, they've been fighting with evictions for the last 2 years, 18 months, at least they know what the problem is. At least maybe they flushed through the vast majority of that already. So I sent out this survey to a lot of you guys. I think these are third of the responses were from family office people. So a little bit more sophisticated investors in here. But yeah, the overall feeling of the market, 72% said, number 2 here, let's be selective, but continue to reinvest. The blue one here was, let's be aggressive. Fear is in the streets, and now's the time to get after it. The rest, which I would say the other 10% here, were spread, but I'm probably willing to say that a good portion of that, maybe 5 to 8% of that, are people who are more sitting on the sidelines. But yeah, I would probably put myself into this majority red zone, which is, yeah, let's be selective, but let's continue to seek out good opportunities and cherry pick good ones. Well, and I think you guys have seen this from us. We haven't really picked up deals since last summer. At some point, I'm not saying that this next month we're going to really pick up stuff. Maybe next year, right? And I think that's the first time I actually tipped off any sort of indication. And part of that for me is my overall belief that if you follow the Chatham financial forward curves or other probabilities of interest rates, I do believe that interest rates should peak early next year, and we should start to see some kind of releasing of that at some point. Maybe it's the peak, maybe it's like that first release. That's when the buyers are going to start to come back into the market and the cap rates are going to return back to normalcy. So going back to our little investor group survey, what are you guys looking for as an investor group to invest in? And shoot, you guys are a little bit all over the place. The majority, 33%, said preferred equity or debt positions. But yeah, that's aligned with what I'm thinking. It's a way of still staying in the game, hedging inflation, but also having your money work in a safer way, in a much more secure part of the capital stack. The second one was an equity position in heavy value add development, which, yeah, I would say for every, I'm 1-to-1, one more into pref equity. For every dollar in pref equity, $1 into development is how I look at things personally. So I guess that kind of aligns there. The other two are people are looking for stabilized, moderate value add, this 18%. Guys, this ain't here anymore. It's not here. I don't see this coming back for the next couple of years. Even if that, I think you're going to miss the market at that point if you're waiting around for that. And then about 19% are looking more for a rescue capital type of fund to go into more distressed assets as preferred equity, which is a safer type of investment form. People who are accredited, 84% of our investor people who did the survey said they're accredited. And then we have, looks like there's a good chunk of people who said they don't know. If you don't know, send us an email, you need to know. But yeah, most of our group are vastly accredited investors. But any questions based on any of that slide deck? If not, we'll go into part 2 here.